Hello, everyone. This is Tom from MarketsFlow. It is the 9th of August, as we bring you this weekly performance for the week ending August 9th, 2019. We're bringing this webcast later than usual due to the fact that I've been traveling. I'm also joined by Adam. Adam, how are you doing?
Oh, very well, thanks. It's nice to be commenting on the week when it's actually closed. We're normally doing it halfway through the session, but we've got some, I suppose, a more definite picture to the week now this time.
Yes, that's right. A bit of a change here. This is Webcast 15 for MarketsFlow's portfolio performance for the week ending. Our podcast is recorded every Friday and is uploaded immediately on YouTube. Please subscribe to our channel so that you can receive it as soon as it's available. MarketsFlow is FCA authorized robo-advisor and digital wealth manager. We're also SEC authorized. Your deposits are protected by the FSCS for up to $85,000. Before we start, I'd like to run through our disclosure. Your capital is at risk and any financial performance figures refer to the past, and that past is not a reliable indicator for the future. With that said, let's turn to the interesting question of the day. How have our portfolios performed, Adam?
Well, this week we have figures of the high growth portfolio down 0.39% for the week, but up 2.87% since the launch of accessible portfolios in very early June. The growth portfolio down 0.27% this week, but it's up 2.67 since that launch in June. And for the ISA portfolio, this one is up 0.2% for the week. And since the launch of portfolios in early June, it has gained 2.16%.
That's great. Thank you, Adam. So how has the market as a whole performed this week?
Well, it's been a very dramatic week. Now, having just passed the week's close, I can tell you that the S&P is down 0.46% for the week, relative to where it closed the end of last week, which doesn't sound like much of a movement. But God, the period between then and now has been quite a roller coaster, especially the early part of the week. At one point on Monday, within the day, it was down about 3.5%. By Monday's close, that loss had been pared back to 3% down, so still pretty grim. But then we saw a positive day on Tuesday, and then opened lower on Wednesday. But then, broadly speaking, positive moves Wednesday and Thursday, and a large part of today. But actually, today ended up being a down day, partly because towards the end we had a sort of losing streak the last hour or two. So here we are at the end of the week. S&P 500 down only about 0.5%. But it's good to be able to point at what the market's been doing and look at our numbers in that context. So obviously we don't claim to be immune from market moves, but we do aim to be on the right side of them. So it's somewhat of a positive to see that we weathered the week reasonably well, being down but by less than the market in these circumstances. And in the case of one portfolio, the ISA portfolio, of course, we're up in the week.
Yes, that's right. So ISA is up this week, and rightly put, it's been a dramatic week, and we've fared reasonably well compared to that. What about the allocations within the portfolios?
Well, we saw our signals begin the week quite negatively, and then proceed to get a bit worse before turning up again towards the later part of the week. But they still sit in somewhat negative territory. There are simply very few stocks that can be assigned a buy signal right now, and a lot that are sells. So what our data engine is telling us is that the price dynamics are simply not good enough for us to settle into a market and take lots of exposure and hold it there. But we did not stand outside the market. We took exposure, but we did so for short periods, and we were quite agile in moving in and out of holdings. The peak percentage allocation, I think, was somewhere around 70%, but that was quite fleeting, and that was primarily just during periods where the market was staging some sort of bounce back, which it did several times during the week, and not usually for very long. So, we will quite swiftly in and out. The average exposure, average allocation over the week, was nowhere near that level. And as to the nature of our exposures, all of them were taken in stock rather than options. The jumpy nature of the market this week, it's meant that the probability of significant losses through option writing was pretty high. And even though, implied volatility was up, so you're getting paid a bit more to participate in that way, it wasn't up by enough to cushion us against those sorts of risks. And, if you are going to have the opportunity to enjoy any upside during those parts of the week where there was a bit of upside to be had, that was much better done in stocks.
Fascinating stuff. Can we assume now, after a week like this, that the regime we've previously spoken about of a calm aggregate market contrasting with the high levels of dispersion between the stocks within it has passed away into history?
Well, the market certainly isn't behaving like that anymore, judging by this week. So this is now, I guess, 2 weeks that we seem to have been breaking away from that sort of market dynamic. Perhaps today, has had a slightly calmer feel about it, but it certainly isn't that remarkable contrast between the components of the market and the top line total of the market that we've been commenting on for the past so many weeks. So you could say that dynamic or that regime is receded somewhat. Whether that's temporarily, it's hard to say. But if we're in a new mode of operation, it's not clear what it is yet. The main characteristic that we've been seeing creeping in is this high volatility. If the bears are correct, and there are quite a few bears out there, a lot of them are speaking on Bloomberg TV and similar forums this week. If they're right that there's a lot more negativity to come in the equity market, then we will continue to see that heightened volatility and maybe further heightened volatility than we've already seen. So if we have turned a corner into something like that, then one thing that will become more important in generating returns compared with the way things were in June and July, one thing that will become more important is varying our overall market exposure over time. Getting that part right or wrong is going to be more decisive for performance. I mean, not just for us, but for anyone investing. So that's, I think, there'll be something to note.
Yes, indeed. Very insightful. Thank you, Adam. How did we risk manage our way through the week?
Well, when you've got so much movement taking place each day, you have to be quick. And we didn't approach the week by having no exposure, even though one way of interpreting our signals would be to say this market looks unattractive. But not everything in the market was unattractive all the time. So we took exposure selectively and became invested. But the speed with which we came in and out of positions was pretty swift. So it took some of how we risk managed by not hanging on to a position too long.
Yes, agility was the key. Is there anything else interesting on the horizon as we look ahead into the coming week or two?
Well, we're past the earnings season really now. There are obviously various items of macro data that will be scrutinized by a lot of people that could potentially be catalysts that push the market one way or another. And there's a pretty lively debate right now about further Fed funds cuts. People will be watching very attentively and listening to every word that comes out of Fed spokespeople. But our process doesn't get into speculating as to whether a piece of news comes above or below expectations, or a central banker is more dovish or more hawkish, and how much that's going to move markets. That's just guesswork, really. What's more interesting, I think, to us is whether we find ourselves in a situation where our signals are more positive again, and perhaps a little of this choppiness we've had in the last 2 weeks goes back out of markets again. But if implied volatility remains a little elevated, which is a way of saying that the expensiveness of options, which we from time to time write, if that remains a little elevated for a little while, I mean elevated in relation to where it was through June and July. Ultimately, if markets calm down, and it will sink back again. But we may get this period where it hangs on to a slightly elevated level whilst actually the internal dynamics of the market improve, and we'll be looking to our signals to judge whether they have. That could be a window of opportunity for us to make more return from options for a while, because we'd be getting a better risk-reward trade-off in doing that. And it may only be, well, it would just be temporary. Most phenomena in markets are temporary. But while they're there, it's a shame not to benefit from them. So that's one of the things I think we'll be looking out for.
Thank you, Adam. So it's been a rather interesting week. That brings us to the end of this podcast. I've enjoyed this, and we'll be back with Adam continuing next week's podcast as usual. In the meantime, thanks for watching or listening to us on YouTube. Please remember to subscribe to our channel and have a great weekend. We look forward to seeing you next week. Bye-bye.